Well, everyone, again, Noah McIntosh with McIntosh Associates, and we are here for your market update this week. While oil flows and drones fly, talks between the U.S. and Iran continue after signing a memorandum of understanding, but there are visible signs that the conflict is far from over. It appears we're back where we were a few weeks ago. Iran is still shooting at its neighbors and attacking shipping in the Strait of Hormuz while we respond with specific targeted strikes. The problem with the current setup is that even a mild escalation can send oil prices higher, which is a win for Iran. And the longer this continues, the less likely oil will decline, even though we ended Friday with oil prices just above the levels they were at before the conflict started. The Iranian regime is waging a delaying tactic at the negotiating table while going on the offensive on the economic front and seems to be assuming we will get bored, leave, and allow their current leadership to remain in power. They also seem to be hoping our economy will tip into recession, causing us to focus inward and forget about them. So far, that doesn't seem to be the case. First quarter gross domestic product was revised upward of plus 2.1% last week, better than the initial reports of plus 1.6%. They're still spending, and the economy has weathered higher oil prices and inflation. AI and big tech dragged markets down. While markets had a rough week, posting early gains at the beginning of each day, only to slide downward as the trading day came to an end. A bevy of concerns roiled the markets, but primarily it was the global sell-off of tech stocks amid mounting concerns over the rising cost of AI infrastructure. We've seen this before. Big tech makes big promises and the market runs with it, then realizes it has run too far and gives some of its gains back. The tech-heavy NASDAQ, that turned out to be a result of negative 4.6% last week. The S&P 500 fared somewhat better, but still declined by 1.95%. The Dow, with the smallest number of constituents on the three major indices, didn't suffer at all and actually came out ahead of the hectic up and down week. A lot of that is because makeup of the Dow's only 30 stocks organically gives it less exposure to the tech sector. However, that changed last week. Verizon was removed from the Dow and replaced by Google parent Alphabet, making it the index less insulated from big techs, while gyrations than it used to be. The other news weighing on markets last week was the latest personal consumption expenditures reading, which confirmed inflation was still climbing. PCE came in at 4.1% versus 3.8% in May, while a core PCE rose from 3.3% to 3.4%. Both numbers are well above the Federal Reserve's preferred inflation target of 2%. Personal spending was up, which has some cheering, but if prices go up, people tend to spend more, but do not necessarily buy more. The problem for the market is that a high PCE reading pretty much sets the Fed on a rate tightening instead of rate cutting path, which will make borrowing much more expensive. The companies that suffer the most when this happens are usually tech companies that rely on borrowing until their products pan out and become profitable. If borrowing costs go up, then whatever nosebleed valuations the markets put on those companies have to be reevaluated and the sell-offs ensue. Markets also reacted to the revised GDP covered in the section above. Our economy isn't bad, it's just not great. And if that were told to be expected great, get meh, at some point it will impact the psychology of the consumer and the investor. Well, coming this week, there'll be a short trading week with markets close on July 3rd. Trading will likely slow to a trickle on Thursday as Wall Street heads off for the long weekend. We'll be celebrating the 250th anniversary of the nation's birth. Happy birthday, USA. Data will start on Tuesday when we'll see the Case-Shiller Home Price Index and consumer confidence. We'll also get to the JOLTS job opening survey for May. On Wednesday, we'll get the latest ADP employment report and MBA mortgage applications. Finally, Thursday, we'll feature the Bureau of Labor Statistics monthly labor report. Consensus is calling for the unemployment rate to remain at a 4.3% and for wage growth to remain flat, while new jobs are expected to increase, but not as much as last month. Well, that's it for your market update for this week. Everyone have a blessed 4th of July, and we will see you in your mailbox next week. Any questions, give us a call at 989-692-2200, or as always, plenty of resources on focuswealthplan.com.